Do you know you could have gained 66% on Zomato's listing and 78% on Nykaa if you were one of the few people who were allotted the stocks of these companies during the IPO and you managed to time the market and exit these stocks at their all-time high, then yes, the game ends for you. But if you are like most of the retail investors still holding the stock or considering whether you should buy the stock now, then the game is far from over for you. In the wake of the current volatility in the market, let's explore the two most popular IPOs of last year and see whether this is the right time to buy or exit these stocks. Let's start with Nykaa. Nykaa is still trading above the IPO issue price. So what is the business of Nykaa? I'm sure you already know this. Nykaa is an omni-channel seller of beauty personal care, which is BPC, and fashion products. It is the largest player in the online BPC market with a 37% market share. So the major segments where Nykaa makes money is BPC, fashion, marketplace, and marketing and support services, and some other smaller areas. For the BPC business, Nykaa works on an inventory-led model, which leads to the timely delivery and availability of the product, and it ensures authenticity of the product as well. For Nykaa Fashion, Nykaa works on marketplace model because the trends in the fashion sector change quickly as compared to the BPC segment. Now, let's get to the important part. What is the moat for Nykaa? Nykaa has created a moat in both BPC and the fashion segment through content-driven customer engagement. It generates the content and then personalizes it for the user to drive the sales of relevant products. This content-driven engine increases the number of transacting customers and the average order value, which essentially leads to a higher profit margin for them. Second, companies usually spend money to acquire the customers, and then when they place repeat orders, that's when the companies make money. Nykaa has been able to establish and retain a large set of customer base, leading to repeat orders, which essentially increases their net profit margin. It established a position in e-commerce space, which helped it to launch its own brand of products and launch the fashion and apparel segment. Now, Nykaa has a presence of more than 100 stores across India and has a tie-up with more than 2,000 brands, which essentially says that they do not depend on a single brand or a product. And the direct tie-up with the brands ensure that they have genuine products on their stores. Let's see some numbers and the metrics. Order per customer. The order per customer for the BPC segment has remained constant for last 3 years with 3 orders per customer. The company is trying to increase this by the content-driven marketing approach. Annual unique transacting customers. The ATC. This is the number of customers who have placed at least one order during the last 12 months. Nykaa's ATC increased to 1.02 crore. The average order value, or AOV. The AOV saw a sharp jump in FY21 when Nykaa increased the minimum order value to avail free discount. But this AOV saw 5% decrease in the next year. The gross merchandise value, or GMV. GMV is basically the total sales. Last year, it grew by 71% with a 3-year average at around 61% growth. Nykaa is one of the few profitable new age companies. However, the net profit last year declined by 33% to 41 crores in FY22. However, the good part is GMV increased by 71% and the revenue increased by 55%. Okay, the existing metrics look good, but what about the future prospects? Nykaa recently launched its B2B distribution platform called Superstore by Nykaa. This is an app that is available for retailers across India. The distributors can check the latest product, check what are the discount offerings right now, and even avail credit facilities. This app increased the transacting retailers by 353% on a quarter-on-quarter basis to around 18,000 retailers. They are also going big on adding new brands through acquisition, like Wanderlust, Dot & Key, Nudge, among others. Now the important part. Let's see the threats to Nykaa's business. Number 1, rise in competition. So the number of direct competitors like Purple are rising, and the indirect competition with small businesses which sell organic and cruelty-free products create a problem for the company to expand its customer base. And number 2, threat of new and big entrants in the market. Reliance is preparing to launch its omni-channel beauty platform. The venture is likely to be named Tiara, and it will run under marketplace model directly under Reliance Retail. This venture will compete directly with Nykaa. Tata Digital is also finalizing plans to run a new e-commerce platform exclusively to sell beauty and cosmetic products. This platform will run in direct competition to Nykaa, and this will be separate from the existing e-commerce ventures of Tata like the Tata Click and Westside. And importantly, the recent expansion into fashion products is yet to generate profits. These low profit segment create constraint on the overall profitability of the group. Hopefully, you got a good overview of the business model of the Nykaa and the financial position. Considering the above information, should you buy, hold, or exit this stock right now? Suppose the company is not able to manage its growth or execute its strategies effectively. In that case, its business plan and expansion may not be successful. If the company is not able to acquire new customers or do so in a cost-effective manner, then in that case also, it will be difficult for the company to manage and increase its profitability. If you look at the charts now, it is right now trading below the 200 DMA, which generally speaking is a good point to accumulate the stock. But you can see the stock has been in a downtrend since December 2021. It has now formed a symmetrical triangle which can give a breakout either upside or downside. A good time to enter this stock would be when it crosses its resistance of 1530 with strong volume. Anything below that is a speculative bet right now. Now let's see Zomato. Zomato is a worldwide restaurant aggregator that started in 2008. It's a pure play technology platform that connects the customers, delivery partners, and the restaurant partners. I'm sure you already know the two major businesses of Zomato: food delivery and dining out. The major source of revenue for Zomato is food delivery, where it charges commission from the restaurant partners. For the dining out segment, restaurants pay an advertising fee to the platform for better visibility. Apart from this, Zomato has two more offerings. Zomato Pro is an exclusive paid membership-based offering that offers discounts to its customers. And Hyperpure is a B2B service where Zomato sources the supply for its restaurant partners, helping them manage their supply chain more effectively. The company started this service in 2019 and currently supplies to 900 restaurants in 6 cities. Right now, revenue from this segment grew from 15 crore in 2019 to 200 crore in 2021. Okay, so what are the strengths of Zomato? Well, marketing is one of the forte for Zomato. Despite being an online entity, it does both online and offline marketing. Its social media channels attract massive fan following. It creates content that amuses the audience as well as tempts them to order food. Number 2, Zomato operates one of the largest hyperlocal delivery network of more than 1.6 lakh delivery partners. 95% of these orders were filled in less than 30 minutes. And third, data. Zomato uses technologies like demand forecasting and fleet optimization to optimize matching orders and the delivery personnel using machine learning. This gives an edge to Zomato over other competitors. Now, you all know how Zomato can use this data to optimize the menus for the restaurant and to gauge customer segments and more such services. So I'll not go into the details here. Okay, now let's see some problem areas. Number 1, security issues. So in the last 14 years since its inception, the app has been hacked several times, and the data of at least 17 million people was at risk. Now these security issues are a big hairy problem for a growing internet company like Zomato. Number 2, inefficient expansion. At one time, Zomato was operational in 24 countries, but now it's trying to pull the plug from inefficient geographies. Now it has realigned its business geographies into 3 parts, mainly India, UAE, and the rest of the world. The company has shut down businesses in Singapore, Lebanon, UK, and the US subsidiary Nextable Inc. They are calling this the Zomato's cleanup drive. Another major issue with the food aggregator is the revenue concentration. In the recent quarterly report, the company mentioned that 60% of its revenue comes from the top 8 cities. The 99% of its revenue comes from top 300 cities. and the balance 1% comes from the next 400 cities. The financials and the problems. The company's quarterly earnings have more or less flattened and the losses have been ballooning. The company has no clear idea on how and when its food delivery business and the Blinkit acquisition will be on the path to profitability. Number 2. During the pandemic, a lot of high-end restaurants had also listed themselves on the platform, which led to high average order value. But if you see the recent quarter reports, the number has been stagnating. Number 3. The monthly transacting users, that is, the users who place order at least once a month with Zomato, has been stagnating. During the pandemic, this number was high, but with the restaurants opening up and the in-dine facilities opening up, this number is also not growing. And number 4. In a recent earning call, the company mentioned that 90% of its revenue comes from repeat customers. And in the future, they are going to focus on the repeat customers. This is a good sign as it basically means the overall cost of acquiring customers is going to come down, which will narrow their net loss. So, where do we stand with Zomato? See, high market share and the growing middle class population in the country will certainly drive growth in the long term. But we need to understand that Zomato had a dream run during pandemic and it will have to work towards sustaining that growth and even try to be operationally profitable. From the technical standpoint, the stock had been in a prolonged downtrend. And unless this breaks this downtrend and the major resistance at 70 to 77 levels with high volume, there is no point in entering the stock. So what is the takeaway? In good times, even poor quality businesses demand sky-high valuation. Investing in low-quality stocks and loss-making stocks is calling for a disaster. You would have observed that poor quality companies cash in on market sentiment and they may even post listing gains. The stock may trade above the listing price for quite some time. But when the fundamentals catch up, these stocks come crashing down. Hence, as a retail investor, it's better to avoid companies which are not profitable and which are struggling with their product. You are not a VC fund, so don't invest like one. I hope you now have a better idea of what to do with these two stocks. And thank you for watching till the end. I will leave 2 more videos here, so do check them out. Wrapping it up, this Paritosh signing off.